Hello everyone. So let's do this chapter 5, the stock market. So this chapter is going to be only a conceptual chapter, okay? Meaning no calculations. The next chapter will have calculations on stocks. All right. So the stock market, I like these quotes. One of the funny things about the stock market is that every time one man buys, another sells. And both think they are astute, right? Because when you are buying, there is always someone to sell. When you're selling, there is always someone to buy. And someone who is buying is thinking that the price is likely to go up. Someone who sells is thinking that the price will go down. So interesting, right? Only one of them will be right, of course. If you don't know who you are, the stock market is an expensive place to find out. Okay, and why is it an expensive place? Because with the stock market, you are putting your money in. You're betting that market will do or move in certain direction, right? And if you're wrong, what happens? You lose your money. You could lose everything. And now you know that, right? So learning objectives, just that's for yourself. So our goal in this chapter is to provide a big picture overview of who owns stocks, how a stock exchange works, and how to read and understand stock market information reported in the financial press like Wall Street Journal, CNBC, Bloomberg, right? So now let's talk about equity, right? Equity or shares, stock, they all mean the same thing, right? So private equity, what is private equity? It is money invested in a company that is not publicly traded on the stock market. Okay, when I say publicly traded, I mean, I guess you all know, like Google, Apple, or Microsoft, this Facebook, right? These all companies, they are publicly traded companies. Publicly traded companies mean these stocks are available to the public, right? You can buy, you can go into, let's say, Robinhood app, and you can buy these stocks. So that's public. But private, they are not traded in the public market. Okay, these stocks, they are available only to selected people, right? Maybe these are people with money, right? Like private investors. So banks are generally not interested. So why does private equity exist? That's the reason is that banks are not generally interested in making loans to startup companies, right? By startup companies, we mean those companies with maybe no assets at all, meaning they only have an idea that they want to materialize, right? But they have not invested in anything yet. Or these are run by fledgling entrepreneurs with no track record. Okay, these are new one. They do not have any history of running this type of companies. So banks will not provide money, lend money to these type of companies. So that's why they will access the private equity market, meaning individuals with money who might be interested in giving these business people, right? These entrepreneur money. Okay. Startup companies search for venture capital, okay, an important part of the private equity markets. We'll talk about what venture capital is on the next page. Firms other than startups might also need financing, okay. Other than startup, we mean maybe these are the companies that already have some track records. Maybe they have been around for 5 years or 10 years, or maybe even longer, and they want to expand, right? But they do not want to go to public equity market yet. Okay, so venture capital refers to financing new, often high risk startups, right? So that's the idea. And we have someone we call as venture capitalist or individual venture capitalist. What do? They are individuals who invest their own money, or they can also be firms that pull money from different sources like pension funds, insurance companies, other than individuals, right? Large companies or university endowments that might want to take on more risk. Usually these university endowments, they probably have huge amount of money. Let's say they have like $500,000, and out of that $500,000, $100,000 they are willing to give out to venture capital entrepreneurs. Maybe these entrepreneurs are the university alumni, right? So you got the idea. Venture capitalists, they know that many new companies will fail. So this is like very high risk, very high return proposition. Okay, investing in like new startups. The companies that succeed can provide enormous profit, right? High risk, high gain. All right. So now let's talk about middle market. Many small regional private equity funds concentrate their investments in middle market companies. What do we mean by middle market companies? These are ongoing concerns, right? They are not startups. They have known performance history. They're typically small and family owned and operated. All right. Reasons middle market companies seek more capital. So why would they need more capital for expansion? Maybe the founder wants to cash out. Okay, so let's say I'm a founder of a company. I have built my company, but let's say I want to retire. Okay, I want to go to another country, do something else, right? So then they might sell the equity to the other individuals, right? Investors. A private equity fund might purchase a portion of the business so that others can now manage the company, okay, instead of the existing founders. So now there is something called as leveraged buyouts. Suppose a company or someone else purchases all the shares of the company held by the public at large. We call it leveraged buyouts. The classic example right now around us would be Elon Musk buying Twitter, right? So Elon Musk bought Twitter. Twitter was a public company when he bought Twitter, okay, and now it belongs to him, right? So that's an example of leveraged buyouts. This process is called taking the company private. So Twitter is now a private company. The cost of going private is often high. A manager or investors who want to take the company private probably needs to borrow a significant amount of money. Okay, same deal when Elon Musk bought Twitter, he bought it for, I believe, like $44 billion. Okay, so he needed a lot of money, so he placed, right, his Tesla stocks ownership and bought Twitter. Okay, so he borrowed a lot of money. He borrowed like billions of dollars of loan when he bought Twitter. Taking a company private is called a leveraged buyout. Twitter's takeover by Elon Musk is a recent example of an infamous, or you can call it famous if you, depending on how you feel about it, leveraged buyouts. Okay. Leveraged buyout market activity levels depend on credit markets. Around 2005, the LBO market was quite active. Activity in the LBO market came to a standstill after the crash of 2008. Okay, so the whole idea is how much money is out there in the economy, right? We use the word liquidity, right? How much liquidity is out there in the economy? The more the liquidity, the more these LBO activities. The less the liquidity, the less these LBO activities. Okay, so selling securities to the public. So now we're talking about public equity market. Okay, so far we've been talking about private equity market, right? Cater to private investors. But now let's talk about public equity market. So within public equity market, we have primary market, and then we have secondary market. We will talk about in a bit. So what's the deal with primary market? It is where investors purchase newly issued securities directly from the issuing companies. Okay, so the issuing companies, let's say Google issued equity to the public back in 2002, I believe. Okay, and that happened. So the company itself issued the equity to the public. So that happens in the primary market. When a company first wants to go public, it happens in the what we call as the primary market. Okay. And within primary market, there can be initial public offering and there can be seasoned equity offering. So what's the deal with those? Initial public offering is when company offers stock to the public for the very first time. So they were like private firm before that, okay? So before 2002, Google was a private firm. Before Facebook went public, I believe in 2013, Facebook was a private company, right? After they issue equity, they become public companies. So the first time they go to the public, right? In, let's say for Facebook it was 2013, for Google 2002, for Apple and Microsoft back in the 80s, 1980s. So that's when they first went to the public. In that market where a company goes to the public for the very first time, we call it initial public offering. Okay, when they go to the public for, let's say, subsequent time, the second time maybe, let's say, then we call it seasoned equity offering. Okay, first time you offer to the public, initial public offering. Second time you offer to the public, we call it seasoned equity offering. And normally companies do not do season equity offering. Okay, normally these public corporations, they go to public only once. Okay, like I said, Apple, Microsoft went to the public back in the 80s. That's it. They have never been gone to the public after that. Of course, the CEOs, the managers, the people who work there, maybe they are selling their equity, right? And we'll talk about that. We call that secondary market, right? But when the company itself sells stocks, the first time that's IPO, the second time that's SEO, and normally companies do not go to the public multiple times. An example of season equity offering would be Google did go to public the second time. I think that happened in 2004. Okay, in 2002 IPO, in 2002 SEO. Okay, Facebook went to public only once back in 2013. Like I said, that's it. Right. So the secondary market now is the market where investors trade previously issued securities with each other. Okay, an investor can trade directly with other investors or indirectly through a broker who arranges transactions for others. Okay, or directly with a dealer who buys and sells securities from inventory. Okay, so there is broker and then there is dealer, right? Two terminologies. So broker, like the real estate broker, they just bring the buyers and sellers together. But the dealer, just like car dealer, right? They actually buy the cars, just like in the stock. They actually buy the stocks, own the stock, and then sell it to whoever wants to buy it from them. Okay, so they actually buy, own, and then sell. But brokers only bring the buyers and sellers together. Again, these days there are like online brokers and online dealers. Like I talk about Robinhood. Robinhood is the online broker. Okay, so now let's say the corporate owners, the managers, if they want to sell their stocks from their company, right? Let's say one of the family members from Walmart, the founders of Walmart, the Walton family, if they want to sell it, they will sell it to other investors, like let's say to me, if I am willing to buy, right? So that's secondary market. So just to reiterate, I want to make sure you understand this part. Primary market is when corporations sell to investors. Secondary market is when investors are buying and selling from each other. So like I told you earlier, Microsoft, Apple, they went public back in the 80s in the primary market. Now if you want to buy like Microsoft or Apple stock, where do you do that? You do that in the secondary market. An example of secondary market, anybody knows what some example of secondary market? New York Stock Exchange, NASDAQ. Okay, so IPO example, all IPOs are cash offers. So your privately held corporation has prospered, but now needs capital to grow. So what do? You hire an investment banker. Okay, who are investment banker? Investment banker are financial institutions that have financial expertise. Okay, so let's say Facebook wanted to go to the public. Facebook, the owner, Mark Zuckerberg, he knows how to do all the coding. He knows how to create a product like Facebook, right? But he would not know how to sell the company or how to take the company to the public, right? How much its stock should be priced and how to go about it. Mark Zuckerberg would not know, or Facebook would not know. So what do? They approach some institution who actually has financial expertise. So that is what investment bankers are. Investment bankers help other companies make investment decisions or financing decisions, like going to the public. Okay, so after lengthy negotiations and analysis, your investment banker suggests selling 4 million shares of common stock. Okay, 2 million shares are given to the original investors. Of course, they want to keep their company, the ownership, and the remaining in exchange for the old shares. After much haggling, the investment banker offers to underwrite the stock issue by purchasing the other 2 million shares from your company for $10 per share. Okay, so after lengthy analysis, what kind of analysis? They are trying to figure out what is the value, the total value of this new company, right? That's what investment banker are doing. They're analyzing to figure out what should be the value of this company, just like how investors would figure out what should be the value of this particular house. If I want to sell this house, what it means the value of my house. Similarly, these investment banker analyze the company, the product, the assets that they have, and their future prospect to determine what should be the value of this company. And let's say in this case, so can you tell me how much is the value this investment banker, how much they think this business, your business, is? From this information, you should be able to tell me from like these last two bullet points. 2 million shares are given to the original investor in exchange of old shares. After much haggling, the investment banker agrees to underwrite the other $2 million for $10 per share. So how much did they value this company? They valued this company to be $40 million. Okay, because for 2 million shares, they're giving 10 per share. So that's 20 millions, right? And they have 4, but they also have the other 4. So for 2 million, the worth is $20 million. So for the remaining 2 million also, it has to be $20 million. So total is $40 million, $20 million worth of the business kept by the original investor, and the remaining $20 million is being sold out to the public. Okay, so moving on, the net effect, you've sold half of the company for 20 million. So the investment banker underwriter, now what will they do? They bought these 2 million from you. Why would they buy 2 million from you? So that they can sell in the primary market, right? IPO, remember. And their idea is they will sell it for $11 a share. So the difference between 10 and 11, that's $1. That's their profit. And that $1 is in percentage, how much is their profit? They bought for 10, they're selling for 11, so that's $1. $1 profit per $10, right? So $1 on $10 is 10% profit. So we call this, you can call that underwriter spread. Okay, an underwriter spread normally ranges between 7 to 10%. Okay, so here it is 10%. All right. So this IPO and an SEO, seasoned equity offering, involves several steps. Number 1, company appoints an investment banking firms. Number 2, so there can be either fixed commitment underwriting, best efforts underwriting, or Dutch auction underwriting. And we'll talk about each of these on the next slide, okay? Company prepares a prospectus, usually with outside help, and submits it to the Securities Exchange Commission for approval. Okay, that's a government body. So all publicly traded companies, they have to abide by the rules and regulations of the SEC. Okay, investment banker then circulates preliminary prospectus, okay, for the investors, which is called as red herring. Okay, upon obtaining SEC approval, company finalizes the prospectus. Underwriters, okay, so this preliminary prospectus is what is submitted to the Securities Exchange Commission. After the approval, now it will finalize the prospectus. And underwriters place announcements called as tombstones, don't ask me why, in newspapers and begin selling shares. Okay. So we talked about 3 types of underwriting. Number 1 is called as the fixed commitment underwriting. So the deal with fixed commitment underwriting is the underwriters, they purchase the entire issue of shares from the company and bears the risk of selling those shares to the public. Okay, and it is the most prevalent type of underwriting in the US. Okay. And then there is best efforts underwriting. Is the terminology suggests the underwriter makes their best effort to sell as many shares as possible, but any unsold shares are returned to the issuing company. Okay. And then there is this Dutch auction underwriting, which is like investors place bids for shares, right? And then the offer price is set on the bids received. Okay, and the US Treasury, right? US Treasury is is the US governmental body, right? US Department of Treasury. They utilize the Dutch auction method for selling notes, bonds, and bills to the public. Okay, right? So now let's talk about what we call as crowdfunding, which is an alternative source of public funding. So what's the deal with crowdfunding? It allows individuals like you and me to pool their money together to invest in or support new ventures, right? Either you are investing in or you are supporting new business venture. Okay, equity crowdfunding, public investors get a proportionate slice of equity in the business venture in exchange for a relatively small amount of cash. That's like obvious, right? Basic, simple. These are some examples. You can click these links on the PowerPoint are some equity funded crowdfunding sites. Okay, equity crowdfunding. So if a company wants to raise money through equity crowdfunding, then they must file with SEC, right? Then they can raise capital through FINRA approved portals, right? These are the example of portals. Okay. So there is greater risk of failure because you are taking huge risk. Like we said earlier, there is a potential for fraud, and it may take years for profits to be realized. Okay, you might be investing and waiting for years. So what's the reward of crowdfunding? The potential for outsized return, right? You can multiply your investment. If you put like $1,000, it can turn into $1 million, or it can go to zero. Okay, so that's the idea. So companies can also raise capital by selling tokens besides issuing debt and equity. Tokens, what's the deal with tokens? Tokens are like, the currency issued by the company. Okay, tokens often grant the holder the right to use the company's services in the future. Okay, so token sales occurs on usually digital security platforms. Okay, and tokens can be exchanged on this platform, one token for another token, or token can be exchanged even for dollar. And I've seen this predominantly in the crypto market. Okay, within Bitcoin and Ethereum, this happens. And within Bitcoin, like Ethereum, this token, right? When we are talking about token, the Ethereum, for example, is the most common platform for issuers, but there are many other competitors. Okay, again, we are talking about crypto. Okay, token sales are most popular among companies that are building services based on blockchain technology. When we say blockchain technology, again, we are talking about the crypto market, right? Like the Bitcoin. Bitcoin is follows blockchain technology, which lies at the heart of Bitcoin and other cryptocurrencies. Many industries, including finance, now they are updating, record-keeping systems by using blockchains. Okay, they're highly advanced. Blockchain is a technology, highly advanced technology, and so far it seems like very trustworthy. The technology itself. Okay, the people there, of course, they can do it for fraud. I mean, I'm not talking about like the prime, like blue chip platform like Ethereum, but there can be hundreds and hundreds of these products that are actually quite fraudulent. Okay, so cryptocurrencies have faced significant scrutiny and negative sentiment from American regulatory bodies like SEC and CFTC, but that has dramatically changed over time. Now, I would say there is more positive sentiment than negative. Of course, it's crypto, Bitcoin, the price can fluctuate. It can go up by like 30-40% within a month, and it can crash by 30-40% in another month. Okay, but I believe it's maturing. So there is secondary market for common stock. The secondary stock market match buyers with sellers. That's what the secondary market does. Okay, so earlier we talked about the primary market. Now that we are talking about the secondary market. So secondary market allows the buyers and sellers to come together, right? So let's say you had bought Facebook stocks 5 years ago. So now you want to sell. Where do you do that? You do that in the secondary market. Okay, trading occurs on either an organized stock exchange or trading network. Organized stock exchange would be like New York Stock Exchange, right, or NASDAQ. And then you, or trading network like Robinhood, TD Ameritrade, right, like that. Important concepts. So when you are buying and selling, there is bid price, there is ask price. Bid price is what the dealers will pay the investors. When you want to buy, you and I, individuals, when we want to buy, we use the ask price when we want to buy. When we want to sell, we sell at bid price. Okay, and dealers are on the opposite side, of course. When we are buying, dealers are selling, right? When we are selling, dealers are buying, right? There are always two entities for buying and selling to happen. So bid price is what the dealers is buying, the price at which the dealer is buying. Ask price is the price at which the dealer is selling. The difference between bid and ask spread, we call it bid ask spread, right? That's what it's called as, and that's their profit. Dealers, right? Dealers attempt to buy low, sell high when moving shares into and out of their inventory. And by, yeah, now you know, that's how you make money. You buy low, you sell high, you make money.